And as you're sitting back and making yourself comfortable, again, just housekeeping, make sure, please, that you keep yourself muted. And at the very end, we'll open it up to questions. So if you're online via a computer, you can chat those questions to us. And if you're on the phone, you can star 6 or unmute yourself for questions. But we'll save that for the end. And I will turn it over to Matt now.
Well said. I'm disappointed that you didn't get that zinger against the big banks on recording. Well said. Love it. Welcome back, everybody. Thanks for joining us again. We're going to have a little bit of fun today. I get to have a chat with 2 of my favorite people at Stockyards Wealth Management. So first up in the spotlight, we have Damon Massey. He is a certified trust and financial advisor. He's also a certified financial planner. He's an advisor here at Stockyards. He is an integral part of the Investment Policy Committee. He's been here for 15 years, and he's been on that policy for all 15 years. He also helps run our core equity portfolio. So he's on the core equity committee. Damon, welcome to the show.
Well, thank you for having me, guys. I am certainly glad to be here.
All right. Very good. I have to take a step back. Jason asked me to do a little update on the market, so I'll give you 2 or 3 minutes on the markets, and then we'll get right back to Damon. But just to touch on the economy real quick, in April, we've lost 20 million jobs. It's been a rough go. We expected this. You know, we saw early on when the global economy started to shut down, we knew that a lot of people were going to be filing for unemployment, and that's exactly what we've seen. And so that brings the unemployment number to just under 15%, which makes it a 50-year low. So things have gotten rough out there, but we do see some light at the end of the tunnel. We're starting to see some things happen in a positive manner. That gives us and a lot of other investors confidence. We saw the first quarter gross domestic product, which is a measure of the growth of our economy. It shrank about 5%. That's a pretty heavy decline, but it's going to be nothing compared when we get the second quarter number. Most of the estimates are somewhere between 25 and 30% decline in the second quarter. So it's been interesting, unprecedented numbers, just staggering numbers. It's hard to even put it into context. But I tell you what's really given us confidence and what's going to help us get through this is the United States government has put $2.6 trillion of stimulus into the economy, much of it in forms of stimulus payments and business loans that are going to be forgivable. So I think you've seen the confidence that investors have in the government to essentially inject money into the economy and to get us to where we need to be before we can reopen. And we have seen many states that are starting to reopen, especially in the South, and looks like so far that that's maybe going okay, and hopefully we see a lot of that going well and continuing to spread on. So, you know, framing up what's happened in the economy, I'd like to talk a little bit about what's happened in the investment markets. The S&P 500, which is a broad measure of the stock market, is down about 9% this year, but that doesn't even begin.
Dad can't help you. You can't ask him if he's done. Okay?
How many minutes is in the call?
Over an hour. It's a long time.
Yeah, so.
Working from home is a wonderful thing, isn't it, guys?
Hey, Matt. Hey, Matt, are you there?
Yeah.
Let's see here. Well, if anyone was on the call early, you heard us talking about technical difficulties. We've been blessed not to have any thus far, and I think I jinxed ourselves by saying that.
Have I lost you guys?
Yeah, I lost you there for a minute.
Have we got him back? Yeah.
Okay. You there, Matt? Go ahead and pick back up. Yeah. I just want to remind everyone, if you're double check that you're on mute. I'm trying to find who's not muted, but just please double check that you're on mute. And Matt, go ahead and pick back up.
I was on a roll. Where did you lose me?
At the start of your roll. The S&P 500 is only down 9%, and that's where we lost you.
Oh, okay. All right. So you heard the part about the economy, and I was leading into, what's happened in the markets based on the economy. So when people lose their jobs, they're not spending any money. Corporations are going to be earning less, and that's what we're seeing with the decline in the market. But the market went down 34% in about 1 month, starting in mid-February. And then what happened right after that is the market came right back up 34%. It's been amazing to see what's happened. Very scary, very nervous at times, not knowing how far down it's going to go, but it's nice to see that we've recovered a long way. That puts us down about 9% on the year. Year to date, down about 9%. Nobody wants to be down, but I'll sure take that over being down 30 or 40%. And over the past 1 year, the stock market is up 4%. So, you know, when you start to look at this thing in terms that really matters to investors over long enough time periods, we're seeing a lot of confidence that markets do go up and they will continue to be up over long periods of time. Oil traded in negative territory, which was unprecedented. The 10-year Treasury is at 0.72%. And here's another interesting fact. The NASDAQ, which is a stock market that basically trades technology stocks, is within 6.5% of its all-time high. So we are seeing, you know, certain companies that are excelling in this market, certain markets that are doing better than others. So now that we're all caught up on the economy and the markets, Damon and I were just getting ready to talk about the Core Equity Committee, which he is an integral part of. Him and his team run that committee. Damon, what is the Core Equity Portfolio?
So our core equity model is a model that is made up of domestic large cap stocks. We usually keep around 40 names in the portfolio, and it's typically what we will utilize in accounts with our larger accounts. But you know, one of the main reasons why you would want to use individual stocks rather than mutual funds is, you know, it provides a lot of transparency, so you can see the actual names that you're holding, and we can control capital gains a little bit better through using a portfolio like that. We can achieve adequate diversification. We have a great team of folks working behind the scenes here at Stockyards with a lot of experience who are working on this committee. So again, we have around 7 folks on the committee. We make all the recommendations for the individual securities that we recommend for our clients. And we bubble those up to our full investment policy committee, which is made up of about 18 members. Again, a lot of really smart folks with a lot of good experience. And they provide the really ultimate approval for what gets recommended. And again, it's a big group of folks looking over the names that we're recommending.
So you and your team run this individual stock portfolio that we use for some of our clients to help them stay invested in large cap stocks. I've seen some information recently about the qualities of these companies. I know there's a number of criteria that you and your team look for when you make these selections. You're looking at balance sheets, you're looking at revenue, you're also looking at other factors about, you know, things that they do good for their community and how they give back. And most recently, I know that you and your team have done some analysis on what they've done in response to COVID. Do you have some names that you'd like to highlight or group together about what they've done recently?
Yeah, sure. So, you know, we've had a lot of questions from our clients about, you know, what kinds of things are we looking for in companies right now, given you know, the circumstances surrounding the COVID crisis, and again, what kind of changes we're making. And we've made a few changes, mostly in relation to making sure that we're invested in companies that are able to see their way through a recession. So, as you mentioned, we're looking at very, very high quality companies. Dividend coverage is a big deal for us, so we're making sure that companies are able to maintain their dividends, and again, that their prospects going forward are strong. So as we exit this crisis situation and this recession that we're in, we're going to have some companies that again are survivors and that are going to fare very well going forward. And again, in looking at our portfolio to make sure that again we're invested in companies that are able to take advantage of some of the things that are going on right now. We've been I don't want to say surprised, but we've been very pleased to find that we have quite a few names on our list that are really at the forefront of this battle against COVID. You know, even if you just look at the retailers that we're invested in, so we're in some of the essential names. So Home Depot and Costco are companies that have stayed open through all this, which is great. You know, so many retailers have not been able to operate up until just recently, as you said, as some of these states are opening things up. Amazon, of course, is our best performing stock so far this year. Clearly at the forefront of things, and really set up for just this environment where you have to rely on delivery of goods. So Amazon has really been a key company in helping everyone with this stay-at-home process that we're all enduring right now. Some other companies, the technologies and communication services companies, again, have been key to allowing everyone to school and work from home. And names in our list that are really the biggest players in this area: Google, Microsoft, Amazon, again, and Apple. Again, have all been very key and important in allowing us to do things like we're doing right now. And those companies wouldn't be able to do the things that they're doing without the infrastructure support companies like AT&T, American Tower, and Analog Devices. So again, these are all names that we've been investing our clients' money in for a long time. Another company that's on our list that you may not have heard of is a company called Roper Technologies. They are a software and technology conglomerate, and they have at least 8 companies under their umbrella that are providing some pretty key services right now. So one of their companies is providing the national testing network in Europe. Another one is providing enhancement to testing equipment. Another one is providing the computer networking for food supply networks throughout the world, really. And another one is providing hospital and equipment and organization management software. So obviously some very important pieces to the puzzle right now. On the healthcare side of things, we have a number of healthcare names that are really at the forefront of the battle. So on sort of the low end, Stryker is a medical devices company that is providing emergency relief beds. So all these pop-up facilities like we have at Kentucky Fair and Exposition Center that are really there to handle hospital overflow. They obviously need beds. Stryker's providing those beds. They're manufacturing about 10,000 a week, low cost, easy to move around hospital beds. So that's obviously a very important function. Medtronic is another company that we're invested in. They have been at the forefront of ventilator production. They're also lending their designs to places like Ford and GM and other manufacturers that don't normally make those kinds of things. And so they again have been a very important company. Bristol Myers Squibb has over 1,000 compounds that are under research for COVID treatment. And then really the more important companies, Danaher is another conglomerate, multiple healthcare companies under their umbrella. Of note, CFID was the first company to come out with a rapid point of care detection test. So the first one where you didn't have to mail it off and get your results 2 weeks later. Another company under their umbrella is a company called Paul, and they are a manufacturing company, but they are the lead manufacturer for Oxford University's potential vaccine that is in human trials right now. So they are prepared to create the manufacturing process and ready to, according to their website, they're ready to make 1 million doses. So good for them. A couple other companies that are really big. Johnson & Johnson, of course, one of the leading healthcare companies in the world. They're providing everything from Band-Aids to PPE equipment. But additionally, they are a leader in immunology. So Johnson & Johnson has already got a very strong proven track record in that they have vaccines for hepatitis, for Zika, for tuberculosis, for Ebola. They also are in late-stage trials for an HIV vaccine, which is really exciting. But they are I read this morning that they're probably going to start human trials for a COVID vaccine sometime in the next few months. So they're a little bit behind the folks at Oxford and a little bit behind another company called Moderna. But again, they are a proven leader in this area. And maybe most importantly right now, Abbott Labs is providing a lot of testing. So they have 3 different COVID tests. They have one called ID Now that is a rapid, get your results in 5 minutes test that's used within physicians' offices. They are making 50,000 per day. As of the end of last week, they've already shipped about 1.5 million of these tests. They have another test that is a large, high-volume test that is used by a lot of laboratories. They've shipped about 2 million of those tests so far. And then they have an antibody test. They've shipped over 4.5 million of those tests, and they expect to develop another 20 million. So again, we have some companies that are doing some really exciting things, and we're glad to have all those names on our list.
That is a lot. I mean, I don't know how many companies you just went through, but it sounds like a good part of the portfolio you manage have done really more than their share and doing the right thing at the right time. I've seen some of the numbers. To say that you and your team have done an extraordinary job would be the understatement of the year. So it's really impressive to see that not only have you picked names that have performed well, but they're also, doing some really great things at a time when the people need it the most. I've seen some names that have really popped recently. Zoom, it's a hot stock. It's technology that a lot of people are using. Have you added any names like that?
Zoom is a good example of a hot stock that we try not to chase. Zoom is up around 150% year to date, but it's only been a publicly traded company for a few months, really. And it's really almost a one-trick pony. So, Zoom has obviously the technology to do conference calls like we're having right now, but so does, WebEx is provided by Cisco. We have, my kids are using Google Classroom and Google Meets for the things that they're doing. Apple, my family's been using FaceTime, so there are a lot of companies that provide the same sort of technology, and we would prefer to be in companies that are a little more proven and a little more diversified. Again, we want to buy stocks that we're going to hold for a long time and that can weather a lot of different storms. And
sure.
Zoom is a hot name right now, but it's not one that we would typically buy.
Sure. Well, I know you and your team have a defined process that you don't deviate from, and it's nice to hear that you're sticking to your guns and not chasing the hot stocks, even though it's probably tempting. Quickly, we don't use this core equity model for every client. There may be clients out there wondering, if I'm using mutual funds, does that mean I'm not getting exposure to these great companies? How would you respond?
Yeah. So again, typically we're going to buy individual stocks in some of our larger accounts. and smaller accounts. We're going to use mutual funds because it's easier to get that diversification. It's a little more efficient for smaller accounts. And really, the mutual funds that we utilize, when we're picking fund managers, we're looking for managers that have very similar processes to the ones that we follow at Stockyards Bank. So there ends up being a lot of overlap. And quite frankly, a lot of times we'll look at those mutual funds to steal ideas for a core equity model as well. So there is a lot of overlap in the name. So you can expect to have exposure to many, if not all, of these names within those mutual funds that you're invested in.
Very good. Very good. Thanks for spending some time. That was very helpful. Enjoyed it. Always a pleasure.
Well, thank you for having me.
Jason Hamilton be my next guest. Jason, welcome to the spotlight. Many of you know him from our previous weeks. He is the manager of financial planning at Stockyards. He is a certified financial planner and just an all-around good guy. Welcome, Jason.
Hey, thank you. Glad to be here.
We're going to talk about financial planning a little bit, which is sort of ambiguous. It means different things to everybody. And your experience as an investor, as a client, might have been at some point in the past 30 or 40 years where you go to your guy your financial advisor, and you've got some money, and they look at your money and they say, well, I'm going to invest it in this portfolio, and you make money along the way, and that may seem like a good thing. Why should I do a financial plan?
Yeah, I mean, great points. And there's a lot that goes into that. So you're absolutely right. For a long time, the advisor, they did everything, and it was, high-level conversations, and they tried to develop goals that, clients were hoping to succeed and achieve and incorporate those. But, oftentimes it was overlooked. Investment management was, everyone's driving point. They just came to their advisor and they wanted to make money in the market, and they really didn't think about a plan of, well, how's everything that's happening in my personal life affected by my decisions in a portfolio. So, why people have a financial plan has really become, it's more or less evolved into being more of the foundation of why we do everything else on the investment platform for a client. Now, granted, you can still have those high-level conversations, and for some clients, for some individuals, that's still appropriate. Back of the envelope calculations, talking through things can certainly achieve many things still. But today, we're kind of here to talk about more of a comprehensive financial plan, and that's where we're using software to really develop a true plan that can be illustrated and shown to someone on paper. As you can see, if you're on a computer here, financial goals, if you develop those, set those out, you're more likely to have success by going through the planning process and developing goals, setting goals. A financial plan also, part of that is you're going to evaluate the risk that you're taking in your portfolios. And we'll talk about that a little bit more probably too, but, very quickly, we'll decide on what's appropriate for, how much equity should be in your portfolio given the goals you're trying to achieve. So that comes out of financial planning too. And then as we're going through the plan, we're planning for the future, really. That's all this really is. It's, from today, certainly, but we're really looking at, retirement and beyond, the legacy you want to leave. And as you're planning, financial planning can help incorporate, large capital needs that are on the horizon that you might be planning for, transfer of wealth. So, wealth transfer comes out of financial planning. How do we efficiently do that for a client? And then if you're a business owner, we're talking beyond that, and it's, succession planning. How are you going to transfer your business to the next ownership? How are you going to get a liquidity event out of your business? And then for most business owners, that liquidity event is their retirement. And you really need to plan thoroughly around that. And kind of how I already mentioned, financial decision-making, as you have a plan in place, it's easier for you to review scenarios, kind of put in different what-ifs, I'll call it, to see if results are achievable or not. And then, a big thing that comes out of this, and it's not only on the individual or the client, but, the advisor too, and that's accountability. Planning today is much different than it was 15, 20, 30 years ago. It's very fluid, and technology has helped us stay very fluid. So when we build a financial plan for someone, once it's built, we can come back in and very easily make a change. Maybe someone was up sleepless at night over the last 2 months, and they're really concerned about the portfolio and the risks we're taking. We can come back to the plan and evaluate, hey, what if I was in a lower equity allocation? Am I still going to achieve goals? And at the end of the day, what we're really trying to show someone is the big picture. And that's so you can understand all of your decisions and how they affect, short and long-term finances.
So I can see, some of the items that make sense. Why should you have a financial plan? All this makes sense. How do you put this together and present it to your clients in a way that's relevant?
Yeah, so the big picture comes together, pretty easily. For those that are, somewhat familiar with planning, they may have heard of cash flow planning versus goal-based planning. And they're both pretty self-explanatory. Cash flow planning is going to be very much spreadsheets. So, we do see a lot of business owners who love to see cash flow planning because they want to see where every penny goes. That's how they're used to running their business. And then there's goal-based planning, which is also very, very popular. And that's more of, what am I saving today to get me to retirement? And then you really start setting goals and letting the program come back and tell you, yes, those are achievable goals, or, you know, no, it might not be achievable. You know, this is what we need to change to make it more achievable. So at the end of the day, whether it's goal-based or cash flow planning, you know, at Stockyards, we try to keep it fairly simple. We don't want to overcomplicate the process. So we do have a little bit more of a bias towards the goal-based planning. You know, the way you're building a plan is you're putting assumptions and different inputs on the front end in there, and it's, you know, longevity. So what's my life expectancy? Inflation factors, investment returns. We're trying to kind of go out there and optimize and project what we think over the next 20 years returns will look like. And then it's very much savings and spending, or, you know, the key parts going in. It's impossible, especially when you look at cash flow planning, to get everything right. And the younger you are and going into a financial plan, the harder it is to get that right. Because if you're 45 years old going through this, you know, you're looking at 35, 40 years of projections out there. And to get it absolutely right is really difficult. So we try to go a little bit more goals-based, allows for a little bit more leniency. And, you know, we know the fine details. You know, cash flow planning is very much like, I use this reference a lot, in the 80s and 90s when computers, PCs became very popular. You know, the common slogan out there was, hey, as soon as you leave with that computer, it's going to be obsolete when you walk out the door, because technology was changing so quickly. Well, cash flow planning is kind of the same way. You know, it's a perfect world illustration. So as I had mentioned earlier, you know, because of technology, it's become much more fluid, and it allows us to, whether we're cash flow planning or goal-based planning, make updates. So, you know, for someone that had a plan in place, they might have been reviewing it over the last 2 months with a 35% market correction, even though the market came back quickly, and plans, you know, maybe at one point looked a little scary, especially if you're trying to retire this year. The market has, you know, brought back account values, and it's made plans look much safer, but it's very fluid. We can easily change something, update values, update goals. You know, if you decide to work longer, or I'm going to retire and I'm just done. And so that's kind of how we illustrate the big picture. For us, we're using, you know, names out there that some have probably heard of. It's eMoney and MoneyGuide Pro. They're the two leading planning software companies out there. No one does it better than those two. And eMoney is going to be very cash flow driven, and, you know, MoneyGuide Pro is going to be very goal-based driven. And why we like MoneyGuide Pro probably a little bit more is the client interaction that we can have with it, as technology is changing the way we do planning. Again, things have become much more real-time, Matt. And we can easily sit down in front of a client with MoneyGuide Pro and go through some things, and it's a very smooth process. So for some of those that might be listening today, they've maybe had a plan done in the past, and it was probably on eMoney. MoneyGuide Pro is new to us. We just launched it this year, part of our new strategic initiative of, you know, how are we getting clients more involved on financial planning. So there'll be more to come from us on that, but, you know, MoneyGuide Pro is kind of our bias for right now of how we show that big picture to a client.
Sure. So we've got access to the two leading providers of financial planning software. You've got the best, most talented, capable financial planning team in the entire country. But even with the combination of those two resources, you mentioned, you know, you're planning for 30 or 40 years in the future with all these variables. How do you know if you're on track and if it's going to work?
Well, you know, that is a great question here. Let me see if this thing will go to the next slide for me, but I don't know why we're stuck. There we go. So how do we evaluate success? You know, great question. So as we're building a plan, obviously if we build 100 plans, we're going to have 100 different successes out there. And the way we're evaluating that is whether you're doing cash flow or goal-based, the Monte Carlo process and the calculation is what really becomes the meat and bones of the entire planning process. You know, obviously we want to make sure we have all the inputs in there correctly, because, you know, it's only good as what the information going in is, the end result. But a Monte Carlo, you know, the probability of success that shows the client's ability to fund goals, and it assumes randomized returns over the client's lifetime. So that's the nice thing about a Monte Carlo. When you're looking at a cash flow report from a financial plan, it assumes an annualized return that's repeated year over year over year. So we call that the perfect world. And we know it doesn't happen that way. So when you run a Monte Carlo and you test all the information, it's going to run simulations of historical returns, and it lumps them together in a very random order. And I think it's probably the truest and the best way to test what you've built, the goals that you've built into a plan. So in this scenario here that I have up, it says that it's a 77% likelihood of success. And what that means, 700, because there's 1,000 trial runs, so 770 times this was a successful outcome. Now, what determines success on a Monte Carlo? 77%. What does that mean to me? For us, we're looking at, you know, anywhere above 70% and higher. And so that's how we're evaluating a financial plan and if it's successful. And it's different for everybody. So if it came up at 70%, technically you're in what we call the confidence zone, but not for everybody is it necessarily where we want to be. So if you're younger and it comes up at 70%, I'd say, hey, you know, let's work on making this a more successful plan. If you're older and maybe you're already retired or you're, you know, 65 or 70, and it comes up 70-ish or low 70s, then, you know, it's a little bit easier to accept that. I think it's fine. Your life expectancy is shorter at that point, and variables are going to be a little bit more controlled. So that's kind of how we really use and rely on the Monte Carlo to make sure we're doing everything right.
I would like the confidence of knowing my advisor is testing my outcome 1,000 different ways. That gives me a lot of confidence to know that they've been thorough with it. You know, you mentioned, you know, risk tolerance. Is everybody okay with 70 or 80% outcome? I have to wonder, does my individual risk tolerance, does my individual portfolio, is that being accounted for when you test?
It is. Very good question. So there's a couple of things that really mean, you know, they're weighted more in a financial plan than other inputs. And, you know, the overall risk that you're taking makes up a big part of whether the financial plan is going to be successful or not. So here I've kind of just shown a plan that has an allocation right here at 54% equities. So very, very conservative. It's essentially a balanced portfolio. And
so half stock.
Of stock, yes, yep. So equities, just 54% stock. You know, the assumption here is this will have an average return of 4.7%. So on the cash flow part, it would annualize, you know, the values of the portfolio at 4.7% every year. But this allows for us to be able to talk through with a client when we're doing the planning process and come back and we do another gut check on the asset allocation that's been put in place for them. We want to make sure that it really is the right allocation. So we'll talk through the risk levels. You know, in this case, if roughly a balanced portfolio, if you had about $1 million account during the Great Recession, so through 2007, at the end of 07 through 09, you would have lost 21% or about $225,000. So we ask you, you know, we want to make sure that you're comfortable with that. Can you stomach that? And, you know, we're evaluating that. And if you're not comfortable with that, we make changes. And then we will illustrate what those changes of being even more conservative might do to the outcome of your financial plan. If there was an adverse of this, is like, oh, hey, that was no problem. I can stomach 21%, no big deal. I could stomach more of a loss than that. I'm fine with that. Then we can show you what being more aggressive in the market looks like, and if it's worth the risk that you're taking to achieve those goals. And, you know, we're able to illustrate all that for you.
I see. So, you know, helping determine how much risk you should take. In terms of my portfolio, does it really make that much of a difference how much stock I have?
You know, it does. So when you look at, you know, when you do pull out the cash flow side and you compare numbers at the end of the day, year over year, risk on paper shows that if you're willing to take the risk, that you should have more money at the end. Here's an example, and it compares a 50-50 allocation, so very similar to what we were just talking about, versus 100% equity, all stock portfolio. And you can see the probability of success isn't much different on a Monte Carlo. You know, a 50-50 allocation with this plan that we had built for a client, you know, it's 99% successful. It's very successful. I'd say you're an overachiever. You're not spending enough at 99%. You could spend more. At 100% equities, it's saying that you've got a 96% probability of success. So still very successful. Maybe to some a little surprising that there's not more of a variance there. But where it really comes into play is when you look at the end of the plan value that's projected. So a 50-50 portfolio is projected to have about $850,000 at the passing of the second spouse here in this scenario. 100% equity portfolio, you're taking a lot more risk, is going to project about $1 million more. So that's where taking the risk, that's where you see it. It's in the true values at the end. It's not necessarily, they're both very successful. But if you're really planning for, hey, I have 3 children and I want to leave some money behind, this could come into play a little bit of, well, how am I going to make sure I have enough money? And you can build that in as a goal too. You can set a specific dollar amount that you want to leave behind. But, that's where equity allocations, the stock allocation part of a financial plan really comes into play. And in this particular screenshot, it's giving you a little bit of a snapshot of, hey, here's my what if, my worst case. If I had a great recession repeat itself, again, that's a 50-50 true allocation, lost about 17% during the Great Recession. And 100% equities, you're all into the market there, so you can expect the worst, and you would have lost about 48% in the market by being all in on stocks.
That's incredible. $1 million difference in your portfolio with only giving up 3% probability of success. I mean, I feel like you have to really pay attention to your portfolio, because not only do you have to assess your risk of losing money, but you have to assess your risk of not having enough money in reaching your goals. And it sounds like you can help clients make that decision with a financial plan. So in addition to determining the risk, are there any other variables that you can adjust or any other advice that you can give based on financial planning?
Yeah, there are, absolutely. And, today we're abbreviating and talking through just the big pieces. What we do when we're trying to change or evaluate, if we're making a plan successful, spending is a big part of that. It's, how much am I spending? And, that and your risk tolerance are probably the 2 biggest pieces. So we're kind of going through, and again, financial planning is very fluid, but it's a collaborative process. I mean, it's a constant, advisor-client interaction, talking through things, really building that relationship so that we both fully understand what we're trying to achieve. And then we can go into a plan. And on Money Guy Pro, like I was mentioning earlier, they do a great job of making it more interactive. And you can fool around with spending. And I'm going to show you here a couple of slides where you can show spending differences or the risk tolerance. So we've kind of gone through that here as we try to make a plan successful. Again, 77% was an illustration I showed you originally, and that is successful. It's in the confidence zone. But let's assume this person was 40 years old, and we're planning way, way, way out. 77% is still a really good score, but we might not feel absolutely confident with that because we have 50 years ahead of us and we're not quite sure. So trying to get to a higher, 92% that we show you here is probably more beneficial. So this is when you want to be an overachiever. And as another reference I always use, I mentioned that earlier. 99% probably is you're too much of an overachiever. This isn't college, and an A+ isn't going to get you anywhere for this. We want you to live a fun and enjoyable lifestyle. We don't want you to feel like you're pinching pennies every year, every day. So if you're at 99% in the confidence zone, I do tell you that you probably could be spending more. Let's get it somewhere around 85 or 90%. That's a pretty nice spot to be. And again, it comes down to that collaborative conversation. If I have a great conversation with a client and I, sense that, hey, they're just not willing to take that much risk of, hey, I'm going to spend more and it should all work out, then, I'm going to let them spend what they're comfortable with. And, they might pass away with a lot more money, and that's going to benefit whoever the heirs are. Maybe it's a charitable organization, maybe it's their kids, nieces or nephews. And if they're comfortable with that, then that's perfectly fine. As I was referencing here, spending is the other part that really comes into play. And this is what makes probably the biggest difference in a plan at the end of the day. I show an illustration here for those that can see it, a 14% probability of success in this scenario. And they're spending $90,000 a year is the assumed expenditures here versus a recommended plan that's at 99%. And how did we get there? Well, we spent only $70,000 a year. So we had to reduce spending by $20,000 a year. For some, that might be asking the world. For others, that's an easy adjustment. But what this tells me is if I was sitting down, Matt, and if you were my client and we built you this, tremendously successful plan versus, your original plan of how you wanted to live in retirement, I'd tell you somewhere probably in between, and we'd be even able to show it in detail on the fly. Somewhere in between this 90 and 70,000, that's probably your sweet spot for retirement. It's going to give you the outcome that we're really looking for, 80-some% probability of success. And that's what makes planning fun. We're able to sit down with clients, again, very much thanks to the technology that's out there, and illustrate to them exactly what these little differences in spending can do. If we flip-flop this, let's just say your current scenario was already at 99% and you were spending $90,000 there, we'd be able to show you, well, hey, we can get you down to 85% probability of success and you're spending, 110 or 120,000. So we can also illustrate it that way. The one thing I always tell everybody at the end of the day, especially if you have a very successful plan, maybe you're that 95 to 99% probability of success. The point of doing a financial plan is to help you with decisions that are coming in the future. How are you planning for retirement? Maybe it's even wedding costs, new cars. I want to buy, maybe a second home or whatever it might be. We want to illustrate to you visually so you can see how that's going to work out, but by no means, I don't want you to change your discipline that you've been doing for years and years and change that outcome, and because you get a very, very successful plan and feel like, well, I can go out and I can be a little bit more loose with my spending. That's not the purpose of a plan necessarily. We don't want to make you too confident where you change all of your habits. So at the end of the day, we don't want to destroy habits. We just want to, we want to illustrate likelihoods of, hey, these are your goals and these are the inputs, what's the likely outcome? And that's what financial planning is.
Very good. Very helpful. I guess if you get me a 20% rate of return, but you haven't accounted for my spending and I run out of money at age 79,
right? You
probably haven't used the financial plan the right way.
Exactly.
Yeah. Very good. That was fun. Enjoyed it, Jason.
Yeah.
You got another slide here?
Well, just something that's often thrown out there. Again, when it comes to planning, the future is very unpredictable. However, what we can do is prepare ourselves for it with the best of our abilities. So, again, failing to plan is planning to fail. Those kind of two quotes go together. If you're not doing it right or you're doing zero planning, you're probably setting yourself up for disaster. Now, again, everyone's got a different outcome, and some can get by with it by flying on the seat of their pants. But for many, just with the volatility that we see in the markets, and we know it's going to continue for years and years and years, there's nothing that's going to change with that. If you really do need to plan so that you don't have to worry about the failure. And that's kind of where I'll leave it.
Absolutely. Well said. Well, I think we'll take some questions now if there's anybody out there. *6 to unmute yourself. We have an email address that you can email questions in. We'll answer them later. Damon is dying to have a question about Apple's balance sheet if anybody wants to get in the weeds on any of his stock picks. So anything related to what we've covered. *6 to unmute your phone for a question. We'll give it a couple of seconds.
And then for those of you that are still on the call, in 2 weeks, we'll have another WebEx. Right now, I think the tentative topic, don't hold me to it, will probably be Social Security and Medicare planning. Do our best to be a specialist in the Medicare world for you. Probably what we'll do there is give you a high-level overview of what to expect when that age 65 comes around for you, and then what to expect when you become of Social Security age, how to best take Social Security, and that's a nice segue from financial planning. So financial planning very much looks at Social Security and spending, and when should I take my Social Security, and we can illustrate that in a financial plan. There's at the end of the day, there's never really a right or wrong. I can only tell you that I can tell you the exact right answer if you can tell me the year that passed. Otherwise, it is a gamble when you're taking Social Security. But it's our bias to believe that you should wait as long as possible. And we're going to talk through that a little bit with you in 2 weeks. And then some Medicare, again, just the planning around that and all the decisions. Anyone have any questions out there? I don't see anything from the chat. Anyone from the phone line? Again, as Matt had said, if you're too shy to ask a question to us right today, you can always hit us up at wmtquestions@syb.com, and we're happy to address any questions that come in. And again, use that email address for suggestions. If there's a topic out there that you would love to hear about that we're not covering, shoot us that note, and we'll certainly review it. Otherwise, it's always our pleasure to do this for you each time that we do it. Feel free, if you ever want to, you can always forward that invite. So if there's someone that that's close to you that you think could benefit from topics, and maybe they're not linked to Stockyards Bank already, that invite's available to be forwarded and sent to whoever that you think would be beneficial for them. They can log in. We don't have any closed doors here with this. It's open to everybody. Give it 1 second for questions on the phone line. All right, I think that's it. Matt, do you have anything to wrap it up with, or?
No, I'm good. Very good. Thank you, Jason. Thanks, Damon.
All right, and thank you, Matt and Damon, and thanks to everyone for calling in today, or those that participated. And we'll see you in 2 weeks. Enjoy your week.